In this session, I'm going to cover cost terms, concepts, and classifications. I'm going to take a look at the overview of cost terminology, and we'll look at how costs flow through the accounting information system, and we'll cover the difference between product and period costs. So first of all, here is the overview of cost terms, and on the left we have the purpose of classifying costs in different ways, and on the right we have the various cost classifications. So for the purposes of preparing an income statement and a balance sheet, particularly to be in compliance with generally accepted accounting principles, we classify our costs into two categories. One is product costs and the other is period costs. Three types of product costs: direct materials, direct labor, manufacturing overhead. And we'll see in a little bit that these costs are usually recorded in inventory accounts: direct materials inventory, work in process inventory, and finished goods inventory. But eventually the product costs are recorded in an expense account called cost of goods sold. Anything that's not a product cost is considered a period cost in this classification scheme. A period cost is a non-product cost or a non-manufacturing cost, and typically they fall into two categories, subcategories: marketing and selling costs and administrative costs. Sometimes there's a third category called just general costs. So it's putting it all together, it's sometimes called selling, general, and administrative expenses or costs. Then for the purposes of predicting changes in costs due to changes in different activities in our production process and the business activities, we would prefer to categorize our costs differently as either variable costs or fixed costs. And we'll be giving more detailed definitions of what these are later. For purposes of assigning costs to different cost objects, like the finished product that's going to be sold to the customer, we would like to classify our total costs into two categories: direct costs and indirect costs. And direct costs are those costs that you can see or infer by looking directly at the finished product. And then anything that you can't see or infer the cost by looking directly at the finished product is considered an indirect cost, or another term for it is sometimes overhead. Finally, for the purposes of the purpose of classifying costs in order to make decisions, we would use three, possibly more, definitions of costs. One is differential costs. If you have two options and you're trying to decide whether to do option A or option B, you want to calculate the cost of option A and the cost of option B, and it's really only the costs that differ between the two options that matter. Sunk costs are costs that are already cash out of pocket in the past, and those costs are they're considered sunk because you're not going to be able to make a future decision to undo what you did in the past. So you should just basically ignore sunk costs. Then opportunity costs are the cost of not doing something and replacing it with something else. And we'll see an example of this later, that if you're going to school, Your opportunity cost is whatever money you could be making during the time that you're in school, but instead you've forfeited that, and you've sacrificed that cost in order to be in school to get your education. So those are our overview of cost terms. Now let's take a look at this diagram that will show us the way that costs flow through an accounting information system, particularly for a manufacturing firm. We usually use the manufacturing firm as our example because it's the most complex scenario that covers the most cost concepts and so forth, and then it's relatively easy to simplify the manufacturing setting into a retail setting where there's going to be less complexity in the costing system. For the manufacturing firm, there's three basic product costs that we call them, and we'll abbreviate them here. With the first one we'll call direct material, and it's an inventory account. Direct material inventory. The second product cost is direct labor, so we'll put DL. And the third product cost we'll call manufacturing overhead, all abbreviated as MOH. So DM, DL, and MOH are our three product costs. That's the costs that go into making the product. If you take the first two, direct material and direct labor, and combine them, those two are sometimes referred to as prime costs, whereas direct labor combined with manufacturing overhead is often called conversion costs. We call the direct material and direct labor, since they're both direct costs, we call them prime costs. And direct costs mean that when you look at the finished product that you're selling to the customer, you can directly infer or estimate what the cost of that material in that product and the labor that went into directly producing that product. However, there were a lot of other costs that went into the making of that product, but not directly. For example, the lights were on while that product was being made with this direct material and direct labor. And those lights, the bill that you pay to keep those lights on, that's part of manufacturing overhead. And you need to have a portion of that light bill included in the cost of that finished product. And let's say that the product that we make for our customers is a chair. Now in that chair, you can see, if you look at it, how much metal there is and how much plastic and rubber and foam and so forth. And just by being in business a while, you'd be pretty sure that the amount of direct material in that one chair, let's say it's worth or costs you $5 in direct material. Then how much labor did you have to spend or purchase in order to get the chair screwed together, and an actual hands-on work by people? And let's say per chair it works out to about $3 for direct labor. So direct material and direct labor adds up to $8 for the one chair. Then it's a kind of a guessing or sophisticated calculation of how much the other items like the light bill, the insurance, the taxes, the salary of the supervisors who don't actually work on the chairs, but they supervise the people that do, the janitors who sweep and clean the place but don't work directly on the chairs. All of that, if you took all those costs and tried to figure out how much of all that should go into the cost of this one chair, let's say that it came out to $2 of overhead allocation. So this is manufacturing overhead applied or allocated to that one chair. Eventually, you think that that chair costs you $10 to manufacture. Then you can go out and try to sell it for $12 or $13 and make some profit. But you wouldn't even know if you had any profit if you didn't know what the cost of your product costs, what your product costs are. Now the one that's suspect is always manufacturing overhead. Are you measuring correctly and allocating accurately? The $2, does that really cover all of your overhead items and allocate the proper amount to this one chair? That's a subject of controversy, and it's a major factor that drives the need for cost accounting. Now, the flow of these three product costs, once you start working on the chairs and begin to produce them, the costs flow out of these accounts into a new account, which we're going to call Work in Process Inventory, WIP inventory. And there, all the costs will be kept while we're in the process of making the chairs until they are finished. Once the chairs are finished, however, the cost associated with those finished chairs moves on to the next account, which is called the Finished Goods Inventory account. And now I've got my third inventory account. I started with inventory of my direct or raw material before they were chairs. And then as I started to produce the chairs, I started keeping track of the costs of those chairs in process in the work in process inventory account. But then when the chairs got completed, the costs got transferred out of work in process inventory into finished goods inventory. So the costs have been flowing out of one account into the next account, and the destination of all these product costs is eventually to get to a final account called cost of goods sold. Cost of goods sold. This is an account, it's not an inventory account like direct material inventory, work in process inventory, and finished goods inventory. It's an expense account that goes on the income statement. So really I've moved the costs off of the balance sheet where all the inventory accounts reside onto the income statement in the form of cost of goods sold. When the costs were in the inventory accounts, they were still product costs, but they were kept and stored on the balance sheet in inventory. But after a sale took place, so a transaction took place, and the chairs are no longer in process, they're no longer just finished, but they're actually sold now, those costs then moved off the balance sheet onto the income statement in the form of cost of goods sold, which is subtracted out of our sales. The retail selling price that you sell to the customer. Sales minus cost of goods sold on the income statement gives me my gross profit, or GP, gross profit. And then there's one more cost that I still have to subtract out, because gross profit is not the bottom line. It's profit, but it's gross profit, so I have to get down and subtract one more thing out before I get my net profit or my net income, sometimes just called operating income. The costs that I subtract out of gross profit are called selling and administrative expenses. So I'm going to call them S&A, selling and administrative expenses. And these are the other side of my costs. The product costs find their destination in cost of goods sold. So this is my product cost that has made it onto the income statement. But the other non-product costs on the income statement are called period expenses or period costs. And the reason that they are called period costs is because they arrive on the income statement at the end of the period. There's no need for a sale to take place in order for those costs to be moved off of one financial statement onto another. These costs, period costs, which are all costs that are not product costs, they are immediately recorded on the income statement at the end of a period, and they bypass the balance sheet completely. So if you take a look at our product costs, started out with direct material, direct labor, and manufacturing overhead, but they were recorded in the 3 inventory accounts on the balance sheet. But eventually, all the costs, including the product costs and the non-product costs or the period costs, show up or are recorded on the income statement. So we have our 2 statements reflected here, the income statement and the balance sheet. And the connection between the two is the transfer of the product costs off of the balance sheet onto the income statement in the form of cost of goods sold. Sometimes product costs are referred to as inventoriable costs because they reside in the inventory accounts before they get to the income statement. They're also called manufacturing costs. And the converse is true. For period costs are sometimes referred to as non-inventoriable costs because they never reside in the inventory accounts. They go straight to the expense account on the income statement. They're also called non-manufacturing costs. Now, just to be clear, we have one more illustration of the difference between a product cost and a period cost. You can think of it in terms of 2 different buildings on a business property. At the front of the building is the street out here, and if you were looking down on their property, you'd see a factory, a large factory in the back of the property, and the sales and administrative store and offices up in the front. Any cost that is associated with the factory in the back of the property is going to be one of your product costs. And that could be direct material, or it could be direct labor, or it could be manufacturing overhead. And manufacturing overhead would be any indirect material or any indirect labor or any other cost that is not direct material or direct labor. But it's not just called overhead, it's particularly called manufacturing overhead because it's overhead that is related to just the factory. There is overhead also down here in the sales and administrative section of the company, but that would not be called manufacturing overhead. It would just be called overhead. Now, down in the sales and administration, we have the selling and administrative costs. So there's where you'd keep the costs related to the salespeople, the sales supervisors and managers, the CEO, those who are the administrators, the executives in the company. And all of these are referred to as period costs because they go on the income statement at the end of the period. They're also called non-inventoriable costs because they're not related, they're not housed in inventory like direct material, labor, and overhead, manufacturing overhead are. And sometimes they're called non-manufacturing costs because they are related to the sales and administration of the company and the products rather than in the producing or the manufacturing of the product, like the factory. Okay? So what's the difference between a product and a period cost? Product costs are related to the factory, and period costs are related to everything that's not the factory. You should have that definition in mind in addition to the prior definition that a product cost arrives on the income statement after the sales transaction, whereas a period cost is reported immediately on the income statement at the end of the period, regardless of whether the sale took place or not. And then finally, just to get another way of looking at the same thing, let's take this diagram here and list out our costs. We have direct material that we purchase, so we can say direct material purchases, and then we've got direct labor that we hire people, and we've got manufacturing overhead as one of our costs, and then our fourth set of costs is the selling and administrative costs. The question on this sheet is, what financial statements are affected or reflected that reflect these costs? Direct material purchases are going to be recorded first in the direct material inventory account on the balance sheet. Direct labor and manufacturing overhead are combined with direct material purchases once they are all three reported in the manufacturing overhead. Oh, sorry. Wrong. Work in process inventory. Sorry about that. Then eventually all those costs, direct material, direct labor, and manufacturing overhead, have to be transferred out of work in process because the chairs or whatever the product is no longer being worked on. It's finished, so it needs to go, the costs need to go into finished goods inventory. And finally, when a sale takes place, those costs, product costs in finished goods inventory, are transferred onto the income statement in the form of cost of goods sold. All this is different from period costs, selling and administrative or non-inventoriable, non-manufacturing costs that completely bypass the balance sheet and go directly and immediately onto the income statement as an expense called selling and administrative expenses. Sometimes they're also called operating expenses, and they're referred to as period costs. Okay, that completes our coverage of the concepts and terminology and classifications of costs. And in the next file, we'll be looking at doing an example that demonstrates the flow of costs through the accounting information system.